The impact of the newly passed Tax Cuts and Jobs Act was the biggest story for fourth quarter 2017 bank earnings. Many banks reported anticipated large write-downs on deferred tax assets. However, just as many banks reported earnings gains related to the revaluation of deferred tax liabilities. In future quarters, Fitch expects most banks will report an earnings boost from tax reform, though it remains to be seen if these gains will be competed away through lower pricing over time. In addition, Fitch expects that most banks will also redeploy some of these tax savings into share repurchases and dividends. Outside of the tax headlines, fourth quarter earnings reflected improving spread income following Fed interest rate hikes, benign credit costs, relatively strong investment banking results, and solid expense management. Not surprisingly, sales and trading revenue fell in the fourth quarter, and loan growth remained relatively muted. Many banks also reported new earnings targets with improved returns. The large regional banks continued to report stronger earnings than the global trading and universal banks, a trend which is unlikely to shift this year. Banks reported lower capital ratios on average for fourth quarter 2017, with large sequential changes to Common Equity Tier 1 due to one-time tax charges. But going forward, capital ratios are expected to level off once certain accounting changes are implemented. Despite the dip in capital ratios, Fitch views the Tax Cuts and Jobs Act as relatively credit neutral for banks and does not anticipate rating changes. Capital levels for U.S. banks are at historically high levels, so some erosion has been expected. Banks have publicly reported low single-digit loan growth for 2018. It remains to be seen if the pace of lending will pick up with the passage of the Tax Cuts and Jobs Act. Commercial and industrial lending has been declining over the last couple of years, since the peak post-crisis in late 2011 and early 2012. Borrowing incentives could become less attractive for U.S. corporates with more cash on hand from the reduced tax rate and changes to allowable interest rate tax deductions. Multifamily lenders could see a boost from changes in mortgage interest deductibility due to increased demand for rental housing as costs of home ownership rise in certain higher-cost states. On the consumer side, higher interest rates have slowed refi activity, which will likely continue to taper off, and mortgage activity will move towards purchases.